At the end of the 1920s, the world seemed to be filled with optimism. After the end of World War I, the United States and other major countries entered an era called the Roaring Twenties. This period was characterized by technological advances, innovation, and rapid economic growth. The US stock market soared, offering hope for a bright future. However, beneath the glow, danger signs began to emerge. Excessive stock market speculation is one of the roots of the problem. People, both rich and poor, raced to buy stocks, often by borrowing money from banks. Unfortunately, these investments were not backed by strong economic fundamentals, but rather by the expectation of instant profits. When the stock market began to show signs of instability, panic spread quickly. In October 1929, the American stock market collapsed in an event known as Black Thursday and Black Tuesday. Stock prices plummeted in a matter of days, wiping out billions of dollars of wealth and destroying people's confidence in the economy. However, the stock market collapse was just the beginning of a bigger disaster. The weak banking system collapsed. Thousands of banks in the United States defaulted on their obligations, causing people's savings to vanish in an instant. The inability of banks to provide credit also halted business activity and investment, triggering a massive wave of unemployment. Government policy mistakes made the situation worse. The passage of the Smoot-Hawley Tariff Act, which increased import tariffs by 50%, exacerbated the depression. International trade declined dramatically as other countries responded by imposing retaliatory tariffs. In addition, the gold standard-based monetary system limited the government's ability to respond to the crisis by printing money or regulating the value of the currency. The problem is made more complex by the huge economic inequality. Most of the wealth is concentrated in a handful of rich people, while the majority of people have enough purchasing power. When demand for goods declines, industries face overproduction, causing prices to fall and companies to go bankrupt. The Great Depression became more than just an economic crisis. It destroyed the lives of millions. Mass unemployment, poverty, hunger, and massive migration became everyday realities. Its effects rippled across the world, causing a global crisis that didn't end until World War II. This tragedy is a reminder that unbridled economic growth, without a solid foundation and prudent policies, can quickly turn into a crippling disaster. The Great Depression was a global economic crisis that left a deep mark on many aspects of human life. Beginning in 1929, its impact extended around the world, affecting the economy, politics, and social life of people for more than a decade. On the economic front, the impact of the Great Depression was devastating. Unemployment rates soared, with millions of people losing their jobs in a short period of time. In the United States, the unemployment rate peaked in 1933 at 25%. Thousands of companies went out of business due to low demand, while the agricultural sector experienced a drastic drop in prices, leaving many farmers destitute. Bankruptcies became a common sight. People's savings simply disappeared, creating a huge distrust of the banking system. Industrial production also plummeted by more than 50%, bringing the economy of almost the entire country to a halt. On the social front, the impact is more poignant. Poverty is rampant, forcing millions of families to live in miserable conditions. Many people lost their homes and had to live in slums or on the streets. Hunger and malnutrition rates rose sharply, while these conditions were further exacerbated by limited access to health services. Family structures changed drastically. Children were forced to drop out of school to help the family, while marriage and birth rates declined dramatically due to economic uncertainty. The Great Depression also created a deep psychological impact. Stress and depression increased, especially among those who lost their jobs and savings. The uncertainty of the future encouraged a widespread sense of hopelessness, creating a mental crisis in various walks of life. In the world of politics, this depression paved the way for major changes. In many countries, the failure of capitalism was considered the main cause of the crisis, which led to the rise of extreme ideologies such as fascism and communism. In Germany, mass unemployment and economic instability were among the factors that brought Adolf Hitler and the Nazi Party to power in 1933. In other countries, protectionist policies deepened international conflicts, which eventually became one of the triggers of World War II. International trade has also collapsed. High tariffs and protectionist policies saw global trade volumes plummet. Export-dependent countries, such as Latin America and some countries in Asia, were particularly hard hit, leading to regional economic crises that exacerbated the global situation. However, the Great Depression also triggered major reforms. In the United States, the New Deal programs introduced by President Franklin D. Roosevelt sought to restore the economy through infrastructure development, job creation, and the establishment of a social security system. While it did not completely end the crisis, it created the foundation for modern economic policy. The Great Depression not only devastated the economy, but also changed the way the world views economic and social stability. Recovery from the Great Depression was neither easy nor quick. After the world was hit by a deep economic crisis at the end of 1929, the process of recovering from the devastating impact took many years, and a wide range of policies and profound changes were implemented in different countries. However, despite the challenges, this recovery shows how resilience and the right policies can help countries recover from devastation. In the United States, recovery began with the introduction of the New Deal program by President Franklin D. Roosevelt in early 1933. These programs aim to provide direct relief to suffering citizens, create jobs, and reform the most affected sectors, such as banking and agriculture. One important first step was the temporary closure of banks, bank holiday, to prevent more bank failures and ensure the stability of the financial system. Roosevelt also introduced a number of social and economic policies, including the creation of the Social Security Act that provided Social Security for the elderly and unemployed, and the Federal Deposit Insurance Corporation, FDIC, that protected customer deposits in banks. In addition, Roosevelt implemented various infrastructure projects through the Works Progress Administration, WPA, and the Civilian Conservation Corps, CCCC, which provided jobs for millions of people in the construction of roads, bridges, parks, and other public facilities. These policies not only helped reduce unemployment, but also provided a foundation for long-term economic development. However, although the New Deal helped mitigate some of the effects of the Depression, the peak of economic recovery wasn't really reached until World War II. When the war began in 1939, the global economy underwent major changes. Many countries, including the United States, undertook massive economic mobilization to support the war effort. Governments spent heavily on the armaments, industry, and war supplies, directly creating millions of new jobs. Factories that had been idle began producing at full capacity, and revenues increased rapidly thanks to military orders. In Europe, countries such as the UK and Germany also began their recovery path. Britain, which had left the gold standard in 1931, managed to improve its economy with looser fiscal policies, including lower taxes and increased public spending. Germany, which was grappling with massive debt and political instability at the time, began to recover after more centralized economic policies and a government led by the Nazis, which encouraged infrastructure development and war preparations. Overall, although the financial crisis and global depression affected the world in various ways, the Second World War ultimately played a large role in accelerating economic recovery. With massive spending on the war, increased industrial production, as well as increased demand for goods, the global economy began to recover significantly in the early 1940s. However, full recovery from the Great Depression did not depend solely on government policies or war mobilization. Social and political transformation also played an important role. In many countries, trust in the capitalist economic system began to erode, which prompted countries to introduce fairer economic reforms and better social security systems. This paved the way for more solid welfare state economic policies after the war, which shaped modern economies. The recovery process from the Great Depression taught the world about the importance of responsive economic policies, the huge role of the state in managing crises, and how social solidarity can help countries bounce back from devastation. The Great Depression provided valuable lessons that are still relevant today. The largest economic crisis in modern history taught the world about the importance of prudent economic management, proper regulation, and rapid response to instability. Although more than 8 decades have passed, the lessons learned from the event provide the basis for modern economic and banking policies and how we face future global economic challenges. One of the most important lessons of the Great Depression is the importance of strict supervision of the financial sector. The crisis started with excessive speculation in the stock market and large bank failures, which led to a loss of confidence in the banking system. After the crisis, many countries introduced new policies to regulate banking, such as the Federal Deposit Insurance Corporation, FDIC, in the United States, which provides protection to customer deposits and maintains the stability of the banking system. Stricter regulation and transparency in financial transactions are key in preventing destructive speculation and ensuring that the banking system remains safe. The crisis also taught the importance of responsive fiscal and monetary policies. When the economy crashed, many countries, including the United States, finally understood that the government should play an active role in restoring the economy.